Thinking of exiting your business or taking on a private equity partner to help you grow faster? BizNexus has you covered. Tap into our network of thousands of best-fit investors, acquirers, and proven M&A advisors, and we'll help you begin the relationship confidentially on your terms, your timeline. Learn more at biznexus.com.
Disclaimer from the always present legal team. Podcast conversations don't necessarily reflect the views of BizNexus Incorporated. Everything you hear is informational news and updates from around the industry. We're not recommending any investments. We're not offering any investment advice. Be sure to do your own homework.
If you felt like the U.S. private equity world kind of hit the pause button in 2023, you are not alone.
Not at all. Financing was tight. Valuations were all over the place.
And caution was just the word of the day. But 2024, that felt different. That was the year the PE middle market really seemed to find its footing again.
It was a definite shift. You can feel it moving from that, widespread caution back toward a kind of guarded optimism.
Driven by some pretty big macroeconomic tailwinds.
And that's exactly what we need to dig into. The real mission here is to understand the how. How did things like easing inflation or even just the expectation of Fed rate cuts actually translate into deals getting done?
And who really won? Was it the big players making huge bets or the smaller, nimbler firms?
The answer is, well, it's complicated.
And before we get into those surprising splits in the data, let's just pause for a second.
Yeah, we should.
This entire deep dive, every number and insight we're about to share, is built on the incredible work of analysts who've been tracking this recovery. Specifically, this analysis comes from the 2024 U.S. Private Equity Middle Market Annual Report, which used proprietary data and had key contributions from analysts like Anu or A9 and John Lebessiere.
It's an essential guide, really. It shows a market that's shaking off its malaise. The stabilization was, I'd say, moderate, but absolutely meaningful.
Okay, let's unpack this with the big headline numbers for the core middle market. Overall, U.S. deal activity grew by, 3.7%?
Yeah, a moderate 3.7% up to 3,262 deals.
But the dollar value jump was the real story. Deal value surged 10.3%, climbing from about $64.7 billion to $71.4 billion.
And that pushed the median deal size up a bit, too, from $50 million to about $54.7 million.
So what was behind that? What opened the floodgates?
It was a direct response to much more favorable conditions. The expectation and then the start of the Fed's rate cuts immediately made financing more attractive.
Lowered the cost of capital.
Exactly. And at the same time, we saw this massive competition brewing, not just between banks, but with the rise of private credit. That competition just bolstered capital availability across the board. And it finally helped narrow that infamous bid-ask spread.
That was the gap that just paralyzed the market in 2023. What sellers wanted versus what buyers would get.
Precisely. It was a chasm. In 2024, it finally began to shrink. And on top of that, you had this immense internal pressure on the PE firms themselves. They were sitting on a mountain of dry powder.
That dry powder was really burning a hole in their pocket, wasn't it?
Absolutely. It did decline through 2024, down to $632 billion by Q4, which is a big deployment jump. But still, there's massive pressure to get that capital working before the funds expire.
But it wasn't a completely smooth ride, especially late in the year.
No. That political uncertainty around the U.S. election definitely put the brakes on things. Q4 saw a lot of firms just shift into a wait-and-watch mode.
Okay, so 3 strong quarters and then a pause. Now, to really get what happened, we need to look inside those numbers.
Yeah, because the recovery was not uniform at all.
Let's dig into this middle market divide. Contrast the smaller deals, the lower middle market, with the really big transactions.
This is where you see a very clear strategic pivot in 2024. PE firms were chasing size.
Chasing size.
Yes. If you look at the larger end, deals between $250 million and $500 million, they saw a huge 18.1% increase in deal count.
Wow.
The mid-sized ones, $100 to $250 million, also jumped 11.5%.
So there's a clear pattern here. The bigger the deal, the bigger the growth in volume.
Exactly. Now, compare that to the lower segment. We're talking about the $10 to $100 million transactions. This bracket actually saw a small decrease.
A decrease in a recovering market.
A 2.5% dip. It went from 429 deals down to 418, essentially flat.
Hold on. If financing is getting easier and the market is stabilizing, why aren't firms putting more money into the highest volume segment? Why is the smaller end contracting?
And that's the key takeaway for you. It suggests a strategic choice. Firms were chasing targets that offered, quote, proven cash flows and greater opportunities for consolidation.
So, safer bets.
They saw them as safer bets in an environment where rates were still pretty high. They wanted established scale over the perceived risk of turning around multiple smaller businesses.
But I have to ask, isn't that a bit less ambitious? If you're only chasing proven cash flows, aren't you potentially missing out on higher returns from those smaller, faster deals we're about to talk about? It feels overly cautious.
That's an excellent point. It's a question of risk-adjusted returns versus just getting capital out the door. And that brings us perfectly to the next critical data point. Speed.
Okay.
Because here's where it gets really interesting. Let's shift from deal volume to deal speed. How long did it take to close these deals?
You'd think with everything getting better, deals would close faster across the board.
You would think that. Yet, the overall average time to close actually went up a little, from 64 days to 66 days.
So what was the drag? What slowed everything down?
It was a fascinating paradox. It was all about size and regulation. The very same deals that saw the most growth, that $250 to $500 million bracket, they were the problem.
They slowed things down.
Their average closing time spiked. It went from 53 days in 2023 to a painful 77 days in 2024.
77 days, that's almost 2.5 months. A 44% increase in delay time? What on earth was going on?
Two main things. First, just more intense due diligence. These are complex assets. But second, and this is the big one, heightened regulatory scrutiny.
The FTC and DOJ?
Exactly. They adopted a much more aggressive stance, especially on roll-up strategies and add-on acquisitions in those larger segments. Big PE firms couldn't just sail through approvals anymore.
A 44% delay isn't just an inconvenience, that's a huge disruption. For a fund trying to hit its IRR targets, what did that 77-day average really mean? Did some deals just fall apart?
It absolutely created systemic risk. That kind of delay directly impacts the IRR of a fund. It forces firms to pour unexpected resources into just compliance and legal review, which eats into their margin on the deal.
Okay, so that's one side of the paradox. What about the other side? The lower middle market, that $10 to $100 million segment.
This is where the efficiency story of 2024 really is. In complete contrast, those deals close significantly faster.
How much faster?
Their average time dropped from about 60 days in 2023 to just 51 days in 2024. That's a 15% decrease. They were the efficiency champions of the year.
So the big deals got bogged down and took 77 days, while the smaller, less complex deals streamlined and closed in 51. That's a 26-day efficiency gap.
It's a huge competitive advantage, and it was driven by that better bid-ask alignment and, crucially, much lower regulatory hurdles. Smaller deals just don't attract the same level of scrutiny.
So their recovery was about speed, even if the industry's focus was on size.
Precisely. Speed was rewarded in the smaller bracket, but volume followed size.
Let's switch gears.
Right.
Where did all this money actually go? What were the sectoral hotspots and, I guess, the cold zones?
Well, business to business, or B2B, is still the undisputed king of volume. It was 37.1% of all deals, nearly 1,200 transactions.
It's just so diverse.
It is. A really bright spot within B2B was construction and engineering.
I'm guessing that has something to do with federal spending.
You'd be right. Deals rose, and the deal value almost doubled to $1.3 billion, largely thanks to the Infrastructure Investment and Jobs Act. It just unleashed a flood of capital.
But the real growth energy, it seems, was with the consumer.
Absolutely. The B2C segment was the breakout star. It saw the greatest percentage growth in both volume and value.
What was driving that?
Renewed consumer optimism. Inflation was softening, and it felt like people had permission to start spending again on discretionary things.
And where did we see that most clearly?
The restaurant sector. It was dramatic. An 86% jump in deal volume. That's PE firms making a big structural bet that consumer spending is back for good.
What about information technology? Did it keep its momentum?
IT was stable on volume, around 558 deals. But the money inside IT shifted. It went to the high-growth, asset-light areas. AI transactions jumped from 39 to 52, and cybersecurity deals rose from 35 to 50.
High growth, low overhead.
The perfect PE target.
And healthcare. Always resilient.
Stable and growing. 489 deals. It's driven by those two powerful long-term trends: our aging population and constant innovation. Home healthcare deals grew significantly.
Okay, so those were the hot spots. What about the cold zone? The energy sector seemed to take a hit.
It did. A sharp 20.6% decline in deal volume, and this was almost entirely down to policy uncertainty around the election. The different approaches to renewables versus traditional energy just made a lot of firms hit pause.
Now that we know what was bought, let's look at where. What does the map of PE activity look like for 2024?
Well, the concentration is still in the usual places, but the big story is migration. The Mid-Atlantic still led, with 19.1% of all deals, the New York and D.C. hubs.
And the Southeast was right behind it.
Very close behind it, 18.5%. That region is just a magnet with its pro-business environment and, frankly, population growth.
But the region with the most explosive growth rate was the South.
Absolutely. The South saw a 13% rise in deals. This area, anchored by Texas, is just reaping the benefits of tax-friendly policies. And the biggest driver was B2C activity, up almost 48% directly following that consumer migration.
And on the other side of that, I'm guessing regions tied to old line manufacturing probably struggled.
That's right. The Great Lakes region saw a decline, and the Midwest had the lowest deal count overall. Both were hit by those ongoing challenges in manufacturing.
So if we sum up 2024, it sounds like a year of, strategic contradictions.
That's the perfect way to put it. It was a year of stabilization, but the recovery was so uneven. It favored the big deals for volume, getting that dry powder deployed. But the lower middle market, that $10 to $100 million segment, was the undisputed champion of efficiency.
So the market prioritized scale, but it rewarded speed in the LMM.
Precisely.
And that speed is going to be so critical looking ahead. The report suggests a strong 2025 is possible. What are the big tailwinds we need to watch?
The tailwinds are pretty compelling. We expect more rate cuts. Lender competition is only going to intensify, which boosts liquidity. And again, that dry powder pressure is not going away.
But what are the risks? What could derail that optimism?
Policy risk is number one. On the one hand, a new administration could bring deregulation, which might speed up those big, complex deals.
But the flip side?
The flip side is the potential for tariffs on major trade partners like China, Canada, and Mexico.
And if that happens?
Tariffs are inflationary, period. That puts upward pressure on the CPI. And if that happens, the Fed's hands are tied. They might have to slow down the rate cuts.
Which would impact everything from financing to valuations.
Across the board.
So we closed 2024 with a market that chased scale, even if it meant a 77-day closing timeline, while the smaller deals were closing in just 51 days.
A huge efficiency gap.
So the thought we'll leave you with is this. With all that dry powder pressure mounting, will PE firms keep chasing the complexity of the largest deals? Or will a renewed focus on speed and efficiency bring capital deployment back to those smaller, swifter transactions in 2025?
It's the battle of scale versus efficiency.
And the clock is ticking. Thanks for diving deep with us.
Acquiring a business? BizNexus simplifies it. Access thousands of updated opportunities in our DIY marketplace or supercharge team sourcing with OmniSource, your all-in-one platform for on-market, off-market, and coming-soon deals. Scale smarter today. Learn more or book a demo at www.biznexus.com.